All right, let's just dive right into this explainer, because we really need to untangle the massive foundational regulatory shifts that have completely transformed the U.S. digital asset market. If you've been following crypto at all, you know the last few years have been, well, an absolutely wild ride. And I'm not just talking about the price charts. I mean right in the halls of government. We're looking at a total ground-up overhaul of how digital assets are actually governed and protected here in the States.
Because for years, there was this one fundamental question that honestly caused absolute chaos. Who actually rules the crypto market? It was kind of like watching a game where the SEC and the CFTC were two referees on the exact same field, but they were blowing their whistles using entirely different rule books. It left everyone in the market constantly guessing. It stalled tech innovation, and it created a literal nightmare, and a really expensive one at that, for compliance teams across the entire industry.
So the root of all this historical friction, it basically comes down to jurisdiction. Historically, the CFTC claimed digital assets were commodities under the Commodity Exchange Act. But there was a catch. Their power was severely limited. They could only really oversee derivatives, things like futures and options, and spot actual fraud in spot markets. Basically, they could catch the bad guys after the fact, but they didn't have the broad authority to actually set the rules of the road for the spot markets where all the everyday trading happens. That essentially left everyone totally in the dark.
So today, we're going to map out this journey to clarity. We'll cover the initial crypto turf war, defining digital commodities, the shift in strategy, the FIT21 Act, and finally, SEC and CFTC harmonization. Let's get to it.
Starting off with Section 1, the crypto turf war, or the battle for oversight.
To really understand how far we've come, we've got to look at the old playbook, which was entirely based on regulation by enforcement. Instead of just, giving the market clear, written rules to actually follow, agencies used lawsuits to set policy. They'd basically sue a company and just let the judge's decision become the new industry standard. It created a wildly unstable environment. Whether you were an everyday consumer or a tech innovator, you couldn't just open up a rulebook to see if you were compliant. You literally had to wait and see who got sued next. It was frankly an incredibly inefficient way to manage a multi-trillion-dollar global market.
But then we hit Section 2, defining digital commodities, which brings us to the 2026 turning point.
This is where things actually shifted from pure confusion to concrete action. The real paradigm shift happened in early 2026, when these two agencies issued a joint interpretation that literally changed everything. The breakthrough was this specific definition. A digital commodity is officially an asset deriving its value from programmatic operation and supply and demand dynamics rather than the managerial efforts of a central entity. Right? So this officially separates these assets from traditional securities, where you're relying on a CEO or a management team to make you a profit. And crucially, this definition finally gave the CFTC actual registration jurisdiction over trading platforms. They weren't just an enforcement agency handing out fines anymore.
And it's so fascinating to look at exactly which assets were formally classified as digital commodities here: Bitcoin, Ether, Solana, and XRP. Having these four mapped out clearly like this gave the market the exact concrete examples it was so desperately begging for. By putting a clear legal label on these massive, widely traded tokens, regulators finally provided the foundational clarity that both institutional builders and retail investors needed.
Moving right along to Section 3, a shift in strategy, getting back to basics. Under new leadership in 2025, the CFTC decided to swap out the endless lawsuits for actual collaborative initiatives. Things like their crypto sprint, where they developed fit-for-purpose rules by actually working with the industry. And the proof that this works is right here in the numbers. Look at this, $228 million. That is the amount of restitution the CFTC secured in the 2025 ImmuniFX case alone. To put that into perspective, it completely proves their new focus. They stopped squabbling over turf and started aggressively targeting actual tangible fraud, like shady robo-advisor schemes, to truly protect your hard-earned money.
Which brings us perfectly into Section 4, the FIT21 Act, creating a concrete framework. Congress really needed to cement these agency changes, and they delivered a total watershed moment with the Financial Innovation and Technology for the 21st Century Act, or FIT21. And a huge part of how FIT21 works in practice is this new decentralization test. It says that if no single entity controls more than a 20% slice of a blockchain's voting power, well, it's officially decentralized enough to be a commodity. It's just a clear mathematical threshold. The guessing games are over. If a network hits that 20% metric, everyone knows exactly which regulatory bucket it belongs in.
FIT21 also tackled a massive practical issue. Where can you actually trade these things?
Under their new dual registration rule, a single exchange has to register with both the CFTC and the SEC. This is huge because it allows them to legally offer both commodities and securities side by side to their users. You don't have to juggle two completely different accounts on two different apps anymore. The market can finally operate the way it was supposed to, seamlessly.
But honestly, the most important part of FIT21 for you, the everyday consumer, are the strict protections it puts in place. It completely bans the dangerous commingling of customer funds. We all know that's exactly what caused those massive crypto exchange collapses in the past. Now, never again can an exchange take your deposits and use them to place their own risky bets. Under these new rules, your funds must legally be kept segregated, totally transparent, and protected.
All of this sets the stage for our final section, Section 5, SEC and CFTC Harmonization, the ultimate resolution.
All those new definitions, the FIT21 legislation, the changing strategies, it all built up to this. Just look at the chronological progression. It's actually pretty remarkable. We go from the CFTC leadership pivot in 2025 straight into that vital joint interpretation on digital commodities in early 2026. And it all culminates in a landmark memorandum of understanding between the SEC and CFTC. Seeing it happen this fast really proves that a coordinated, sensible government approach is entirely possible when everyone finally gets on the same page.
The direct result of that memo is this beautifully unified federal policy. By agreeing to share surveillance data and conduct joint examinations, the SEC's Project Crypto and the CFTC's Crypto Sprint are basically operating as one unified force now. The goal? To drastically reduce duplicative oversight and actually give the market fair notice. Basically, it means no more getting contradictory warning letters from two different federal agencies on the exact same afternoon.
So, taking a step back, what does this all mean for the future of the market? Well, the era of regulatory uncertainty is officially closing. The narrative has completely shifted. We're no longer arguing about whether crypto is legal. We're talking about how it can be safely and securely integrated into the global financial system. And sure, higher compliance standards are firmly established now, but honestly, those standards are exactly what provide a clear, stable pathway for actual, lasting innovation here in the US. And that brings us to the most important question to ask ourselves as we look ahead. With a clear, unified pathway finally established in the US, what groundbreaking financial innovations will this newly stabilized market unlock next? It's like the foundation is finally poured. So I'll leave you with that thought to chew on. Thank you so much for joining this explainer, and keep questioning the future of finance.